Okay, next up is Adrian Cronje. He's the Chief Executive Officer and Chief Investment Officer of Ballantine, the Atlanta-based wealth management firm serving entrepreneurs and business owners. A Cambridge-educated economist and highly rated and frequently requested Vistage speaker, as well as a longtime member himself, his favorite lesson for CEOs from his Vistage talks is that the secret to predicting the future is to become a student of the capital markets, and that managing your business is different than managing your wealth. Adrian serves as a trustee and chair of the investment committee at Agnes Scott College and as a charter member of TIE Atlanta, an organization dedicated to fostering entrepreneurship. Last fall, he was named a TIE 2018 Top Entrepreneur. And today, Adrian will provide insight to and implications of the 4 key themes which will determine what's in store for the economy and capital markets in 2019. The final encore, have the economy and bull market run their course. Adrian.
Thank you very much, Linda. Good morning, everybody. Hopefully my slides will appear at some point. Did you know that we are on the cusp of a major milestone in the economic history of our country? And that is, if nothing untoward happens between now and July, the media will be reporting in August that the expansion that started way back in the summer of 2009 will go down in the record books as the longest period of uninterrupted growth in the history of the United States since the National Bureau of Economic Research started collecting data way back in the 1850s. Reflect on that. My first slide shows actually, when it eventually appears, that this expansion, thank you very much, that this expansion that started in June of 2009 has already eclipsed the decade of the 1960s. It has surpassed the decade of the 1980s. Only the decade of the 1990s stands before it and its place in the record books as the longest period of uninterrupted growth we have ever enjoyed. More than twice the average length of an expansion since the Second World War. History tells us to expect recessions twice a decade, like we had between 2000 and 2009. We haven't had one for well over 10 years. And I'll tell you this, as I've gone across the country, speaking to Vistage groups, I see it in my own Vistage group, where 16 out of 18 members last year had their record bottom line number in the history of their companies. The question is, how long can the good times last? And the number one issue really has been, how do we retain and attract talent in a very hot labor market? Just as economic performance has been stellar, last year the economy grew at 3% after inflation. The labor market is as strong as it's been since the 1960s. I know you all know the challenges of trying to attract and retain talent in today's hot labor market. And the question Vistage members have asked me over and over again is, how much longer can the good times last? Almost anxious to call an end to this cycle, realizing that we've had it good for a very long period of time. And my answer to that question is the same as I've always given, which is, don't ask me, don't ask economists. We actually have a lousy track record at forecasting the future, especially major economic downturns. But I will tell you that if you invest a little bit of time in understanding the messages that capital markets send each day, you will get a much more reliable predictor of what's likely to unfold over the next 12 to 18 months. And I don't have time in the 20 minutes I have with you this morning to go into that in detail. I do have an article out front that speaks to that playbook in detail. But the bottom line is, if you all, as CEOs, invest a little bit of time in understanding the messages that not just the stock market, but also the bond market and the credit market and the commodity market send you each and every day, you are likely to be much more informed on the 4 key themes that Linda suggested are so crucial to the outlook today. So let's start with everybody's favorite leading indicator. Here is a chart of the US stock market, the largest 500 companies in dark blue since 2009. What remarkable plain sailing that has been for equity markets. The S&P 500 has gained nearly 4-fold since the last bear market we experienced in the aftermath of the great financial crisis. The US market, coincidentally, and that's a story for another day, has absolutely trounced international stock markets over that time frame, which speaks to the challenges of a diversified approach in this past cycle. But plain sailing, nevertheless, until the Grinch stole Christmas in December last year. I remember sitting down to Christmas dinner at around 4:30 on the 24th, realizing that the S&P 500 had just closed down 19.8% since its previous high water mark, the closest it has ever come to a bear market since 2009. And so the stock market was starting to sniff out some potential weakness in future corporate earnings and in the economy that we needed to start to pay close attention to. The question before us, as we've authored, is, was this the beginning of bear pause, or was this simply a bull pause? And by bull pause, I mean a period of time in the stock market where it experienced volatility, reset expectations before it continued on to another high, just like it did in 1984 and like it did in 1994 in those bull markets, and it did in late 2015 and early 2016 as it did in this particular bull market. Or was it in fact starting to discount something more sinister? And I'm going to touch on the answers to those questions using some of the clues that the other capital markets signal in the meantime. But before we do that, I'd like to remind everybody of one observation. Bull markets do not die of old age. They die because the environment that policymakers have created mean that the economy has to slow down and go into a recession before it starts to expand again. And so the real issue in 2019 that CEOs and the entire C-suite needs to get their arms around is, what are the key issues as it relates to the policy environment as to whether this economic expansion can continue and whether this bull market in stocks can resume. And before I go there, I will remind everybody of this particular chart. I had to stay grounded in this as I sat down to Christmas Eve dinner. December's volatility felt bad. It felt jarring. Not because December was typically unusual, but because we had had such a low period of volatility for such a long period of time. And I see several of you nodding on that point. Remember, 2017 was the lowest period of volatility the stock market had ever recorded, which spoke to how certain everybody was about 2018 being such a robust year for the economy and markets. And that, as you will recall, was my message a year ago when we walked through the outlook at that time. So stay grounded in that reality. Unfortunately, the truth is, investing in the stock market is risky. It comes with volatility. And the volatility we experienced in December and during the fourth quarter of last year is actually more representative of a normal investment environment. So, as a reminder, there is a strong correlation between the volatility in the stock market and the stance of monetary policy, and I'll get to that in a moment or two because that's one of the key policy issues that you all need to educate yourself on. You will see that periods of below average volatility typically coincide when the Federal Reserve is being quite accommodative or keeping interest rates low. Volatility tends to pick up when they walk that back. So here are the key themes this year. The first is Federal Reserve policy, essentially the interest rate environment today and over the next 12 to 18 months. The second is the lingering effects of the 2017 Tax Cuts and Jobs Act, or tax reform as it's become known, and what impact that has on CEOs' confidence and corporate America. The third area is a new wild card that last year generated, which is trade policy. And the fourth area, which nobody is talking about just yet, but unfortunately the government shutdown that we experienced and ended late last year may be a harbinger of, is the issue of debt and how we're going to pay for this all, given the fact that last year's midterm elections delivered a gridlocked outcome. So let's take a quick detour through each one of these issues and remind ourselves of how you can monitor how this issue is unfolding in real time using the capital markets. So let's start with Federal Reserve policy. This afternoon, Jay Powell at around 2 o'clock is going to be making an announcement on the FOMC's latest decision about what they're going to do with short-term interest rates, and what everybody's focusing on is what they are going to do in the future to reduce the giant balance sheet that they had built up in the first few years of this crisis in order to stimulate the economy. Isn't it lucky that we have Dennis Lockhart here at 2 o'clock to talk about monetary policy in great detail? Right here in Nelson Mullins, we may have a market-moving event, but I'll leave that to Dennis later this afternoon. Let's remind ourselves of what the Federal Reserve is trying to orchestrate. Let's think to the CEO summit 3 years ago. I think my colleague Robert was talking about Fed Up and how the Federal Reserve had to engineer the recovery during the first 7 years. In the early part of 2015, short-term interest rates were at zero. After inflation, they were negative 2%. And they had built up a balance sheet of $4.3 trillion of bonds in order to recapitalize the banking system and get everybody spending and investing again. And Janet Yellen at the time said, we are going to have an orderly walk back of all of this monetary accommodation without making a mistake. That's a daunting task. 3 years later, we're at 2% on the short term. In inflation-adjusted terms, only zero, and the balance sheet is still around $3.7 trillion. We have a long way to go. We have a huge communication exercise in front of us from the Federal Reserve. What really caused the volatility in December is when Chairman Powell said, we are a long way from the neutral rate, which markets interpreted that we were going to have to raise interest rates pretty aggressively in 2019 and unwind the balance sheet very quickly. So much so that a policy mistake would occur and the economy would tipple into a recession. And I want to remind everybody of a slide we produced 3 years ago. I'm often asked, what is the direction of interest rates? This is the most difficult job to forecast in my business. I think Robert first introduced this slide. This goes back to 1982, and it shows each successive Fed chairperson all the way since Paul Volcker, through Alan Greenspan, through Ben Bernanke, through Janet Yellen. I've been fortunate to actually meet each one of these individuals, and I can testify that Ben Bernanke is actually standing on a box. Nevertheless, you can see a clear correlation between the level of long-term interest rates and heights of successive Federal Reserve chairs. Jay Powell is now a towering 6'5". Yes, Ray, interest rates are going up. There's a serious point in this slide. Federal Reserve policy, calibrating it just right so that the economy can continue to expand, not overdoing it, not making a communication misstep, is absolutely vital to the outlook. So I'm looking forward to listening to what Dennis is going to say about this particular issue this afternoon, since he's had a front row seat on this issue over the last 7 years. A quick reminder, and I dwelled on this last year, but it's in the article that's available on our desk. This is an indicator that's attracted a lot of attention recently in the media, but it's something that has been worth noting for people in the C-suite for a long period of time. Each and every day, the bond market is telling you whether the Federal Reserve has set monetary policy appropriately. And this chart shows the yield curve, or in plain English, the difference in short-term interest rates versus long-term interest rates. And what you should take away from this slide is that for the most part, the yield curve has a positive slope. And that's because the bond market thinks in future the economy is going to grow and interest rates will have to rise in order to curb inflation. When the yield curve starts to get flat or even inverts such that long-term rates are lower than short-term rates, that's the bond market's message saying, look out. The Federal Reserve have overdone it and they're going to have to lower interest rates because there's an economic slowdown occurring. In fact, this indicator has been perfect in predicting future recessions over the last 30 years. No recession has started in the US without the yield curve first inverting 12 to 18 months before a recession occurred. So today the yield curve is flat, but still retains a small positive slope. And that's really, really key for you all to think about, because if it does start to invert, that's a pretty clear piece of the puzzle that suggests that 2019 might not just be slower growth, but a more sinister contraction. The second issue, and I'm reprising a slide that I did last year when I talked about tax reform in detail, shows President Trump sitting in front of a barbecue with a tax bill thinking to himself that we cooked this up in a real hurry. I hope there's nutrition in there somewhere. And of course, the tax bill a year ago, all the headlines were about lowering the tax rate for C corporations to make America more competitive again, to simplify the tax code, to provide incentives to bring back profits and create jobs in the United States. But the really underreported issue on the tax reform bill, and a key piece of the puzzle as to how much further this expansion can continue, is the deliberate incentives it created for us in the C-suite to invest in our future again, through accelerated depreciation allowances, by removing allowances to deduct debt, where financial engineering and everything else was such a key part of growth in the first stage of this cycle. And so this is an issue that the Federal Reserve is watching every day. Are corporations taking advantage of the tax bill to invest in the future again, so that their companies can be more productive, so that the economy can continue to grow in aggregate at a rate of 3% in a sustainable way? And I thought it might be interesting to show you some stats. There was a survey run by Korn Ferry of 152 companies, and this was in late summer of last year. And it shows all the ways in which CEOs and CFOs reported how they were spending their tax savings. And I've highlighted 3 areas in green, suggesting that tentatively that supply-side stimulus that policymakers had in mind was starting to be effective. 49% said that they planned to increase their capital investments at a faster rate. 34% said they were going to invest in employee training. 26% said they were going to increase hiring at a faster rate. I've highlighted in red some of the financial engineering techniques we've used in the past to drive growth and returns. Some corporations were going to use the tax cuts to pay higher dividends or pay greater bonuses or increases the rate of share buybacks. Nevertheless, the data was telling you by late summer of last year, capital expenditure and investments were starting to pick up pretty significantly. CEO confidence was high. And the capital market indicator I'd encourage you all to become educated with as a real-time gauge of sentiment in the corporate sector is what's happening in the credit markets. So this chart shows the rate of interest corporations have to supply in order to float bonds and finance themselves. And it compares that spread versus safe bonds. And you'll see that on average, corporations have to offer about a 500 basis point premium over safe treasuries in order to entice investors to take their bonds. So this is the non-bank financing channel of corporate America. Those spreads tend to rise close to and during the early stages of a recession. That's the credit market telling us that they are expecting a slowdown and a significant increase in default rates. You will notice during the fourth quarter that credit spreads discernibly picked up somewhere in the order of 50 basis points, but are still roughly around the historic averages. If this starts across all sectors to rise meaningfully, that would be a signal that 2019 is not just a bull pause and a slowdown in economic growth, but that a recession could be appearing on the horizon sooner than people anticipate. So CEO confidence was key, and tax reform was working its way through the system until the wild card of trade appeared. And I highlight from our president 3 tweets in March, July, and December how this policy issue, something that people hadn't realized, was really becoming an issue not just of wanting to update free trade agreements, but really going after China to improve their trade practices and stop them from allegedly taking our intellectual property. I'm a tariff man, he said on December the 4th, and you can see what the commodity market said. Commodity markets give you a real-time gauge on the health of the Chinese economy. And so we're playing a high-stakes game. If there is any sign that we're not able to reach an agreement before the end of this month to avoid tariffs going up by 25% across a broad range of goods and services, that would be another indicator to you all that the slowdown would be more meaningful in the next year or two. And then finally, the fourth theme, national debt. So we've had a government shutdown of nearly a month over the funding of a border wall. On 2 occasions this year, Congress has to approve raising the debt ceiling. We now have gridlocked government. And I want you to just spend 10 seconds looking at this slide, because this is a slide that Alan and Brian Bolio have been consistent on, which is, when do the chickens come home to roost? This is a proportion of our national debt. So this is really government debt measured in trillions, right? So this chart is a few trillion here, a few trillion there. All of a sudden, it's some serious money, right? Yeah. National debt today is at $22 trillion. Before the last recession, national debt as a proportion of our GDP was 62%. Today, it's 105% of GDP. We have to make some really serious policy choices to get ahead of that. Take a look at how the national debt has grown and watch how the political debate in Washington will unfold, because that'll be a key theme this year. So I will quickly run through those implications for business owners. It looks to us that the capital markets are telling us that fall is here, if not winter. There are 4 issues I'd encourage you all to think about, just as we are doing in our own business. If you do decide, and this is important for those of you who are going through or contemplating a transition event, think that the runway may be shorter than 2020 to accomplish your goals. And there is a paper that we've put outside. We sit at a pretty unique vantage point in the ecosystem of entrepreneurialism and business owners in Atlanta. We help those folks plan for their transition event. We invest in strategies. There's a distinct playbook for you all to think through, and I would welcome those conversations at lunchtime. There are other resources out there that I will call out through the Vistage network. We've collaborated with the Bolio brothers on some of these topics in much greater detail, so become familiar with that. Our website has several resources available for you all on some of the issues that I've tackled today. And then finally, just a reminder, we do a capital markets forecast every year where we take a look at what the next market cycle might bring. And our conclusion today, so far, is that we experienced a bull pause, not a bear pause. But 4 key policy themes stand to decide what that outcome might be. So thank you very much for your time.